So look at this return on capital employed. In year one, it was 15%. In year two, it's gone down to 10%. Now, when you see that in the exam, you've got to think to yourself, why? What is the effect? What's caused this? And just look at the transactions that happened in year two and see what effect did they have on profits, but what effect also did they have on your capital employed, your debt and your equity. For example, let's say there was a big revaluation, change of policy in year two. Well, just because it's a change of policy, then that means all your revaluation, all your assets have gone up. And so you will get a smaller a depreciation charge, a small depreciation charge, which would reduce your profits, but you have a huge revaluation reserve. And because of that, that would drag down your capital employed through no fault of your own, just because you've changed your policy. So there you'd say, look, the company's not struggling, it's just had a change of policy, and that means that its capital employed has changed more than its profits, but we understand why. Now, another example could be just comparing two different industries. If one's in the manufacturing industry and one is like accountancy or knowledge industry, well, the manufacturing company should have a far lower return on capital employed than accountancy. Why? Because the manufacturing company needs more assets, needs more capital employed. And so therefore, their denominator will be far bigger, and therefore they will get a lower return on capital employed. So comparing two companies in different industries is pretty pointless. What you want to be doing is comparing to companies in your industry. What about this then? A company that leases assets compared to a company that buys its assets. Well, if you buy the assets increase, but then your cash decreases, so there's no effect. Whereas if you lease your assets, you're going to get a lower return on capital employed because when you lease your assets, you've got more liability, you've got this lease liability, more debt on your balance sheet. And so therefore that will be bigger than the company who's just bought assets using cash. They've got no debt, and so therefore they will have a bigger return on capital employed. So always be aware of that. Companies that lease assets, they will lower their return on capital employed. Finally, have a look at timing. If you buy assets at the end of the year compared to buying them at the start of the year, your capital employed will stay the same because you've still got your assets bought however way, let's say by debt. But it's the profits that makes the difference. If you bought them at the end of the year, you've got no time to make any profits. And so therefore your capital employed will be a lot lower than a company who bought assets at the end of the year. Now, we're not saying one is right or wrong. You're just trying to explain this is the reason why the capital employed or the return on capital employed is different.